Welcome to Spidell's California Minute. I'm your host, Catherine Zidane. This week we're covering whether employee retention credit adjustments are required on the California return. A tax season review is an invaluable opportunity to examine issues or challenges while they're still top of mind. Sign up for Spidell's post-tax season update and review webinar and ensure no questions from the recent filing season go unanswered. Get registered at caltax.com under webinars. California does not conform to the federal employee retention credit. For California purposes, the employee retention credit is treated like any other federal credit, which means that California taxpayers do not have to report any employee retention credit refunds as taxable income on the California return, and taxpayers do not have to reduce any wage expenses for which the credit was claimed. According to recent reports, the IRS has started approving many of the employee retention credit refund claims that have been on hold, which means tax professionals are having to address their reporting requirements. According to the IRS, taxpayers that receive an employee retention credit refund years after they claimed the refund are no longer required to go back to the year the wage expense was incurred to reduce the wage expense for that year. With so many businesses receiving employee retention credit refunds in 2024 and even 2025, many tax professionals are asking whether they have to make an adjustment on the California tax return when they reduce their wage expense deduction on the 2024 or 2025 tax year return or amended 2023 tax year return. Because California does not include employee retention credit refunds in taxable income and does not require a reduction to the wage expense, generally speaking, there is no adjustment to be made on the California return. However, the increased wage expense on the federal return may still have an impact on the California return for sole proprietors and pass-through entity owners. This is because numerous deductions claimed on the California return are based on federal AGI amounts, including but not limited to the medical expense deduction and the 2% miscellaneous itemized deduction. Because a taxpayer's reduction of the wage expense on the federal return increases the amount of their federal AGI, this will also impact the amount of these deductions that can be claimed on the California return. Another common question that arises is, what is the correct basis adjustment for flow-through business owners that receive employee retention credit refunds? At first glance, it would appear that there would be a basis difference because the income is tax-exempt under both California and federal law, but only California allows taxpayers to claim a full deduction for the employee retention credit wages. However, when the journal entries are actually made for these transactions, it becomes clear that there is no basis difference for federal and California purposes in the end. When the federal income tax return is amended to reduce the wage deduction by the amount of the credit claimed, the taxpayer's basis is increased because net income is increased. On the California side, once the employee retention credit refund is received, it's credited as tax-exempt income, which also increases basis for flow-through business owners. This increases the California basis by the same amount as the increased federal income caused by the reduced wages on the federal return. We covered this topic in a recent issue of Spidell's California Tax Letter, a monthly newsletter written by California tax professionals for California tax professionals. You can get details and subscribe at caltax.com under publications. That's all for this week. Join us next time for another episode of Spidell's California Minute.